What if you had to make a choice between your core principles and billions of dollars in investment? It sounds dramatic, but that is the high-stakes dilemma facing Australia right now. It's a choice that could seriously shape its economic future. And, believe it or not, it all comes down to a special tool used by the world's most powerful tech founders.
Here's how we're going to break it down. First, we'll look at this golden ticket that lets founders keep total control. Then, we'll see what it costs everyday investors like you and me, and why this whole model is so hard to kill. That'll set the stage for Australia's big problem and the tough choice between sticking to its values or getting left behind.
All right, let's start with that founder's golden ticket. This is the secret sauce that lets founders raise billions of dollars from the public market without ever giving up the driver's seat.
I mean, think about it. It's a question that really gets to the heart of how modern companies work. When a company goes public and sells shares to all of us, shouldn't we get a say in how it's run? Well, as it turns out, not necessarily. There's a pretty clever bit of financial engineering going on.
The answer is something called dual-class shares. It's pretty simple, actually. A public investor, someone like you, might buy a Class A share, and that gets you 1 vote. But the founder? They hold special Class B shares, and each one of those might get 10 votes or even more. This means they can own a minority of the company, but still have an iron grip on every single decision.
But look, this isn't just some theoretical issue about who gets to vote. For regular investors, this has very real, very direct financial consequences. And it means your slice of the pie can actually start to shrink.
Right. Without a real vote, public shareholders are basically powerless. They have no way to stop founders from making decisions that water down their ownership. And that means your piece of the economic pie gets smaller and smaller over time. And here's a major way they do it. It's a practice called stock-based compensation, or SBC for short. The company essentially just prints new shares out of thin air to pay its employees. Now that's great for the employees, but every single new share they create makes all the old shares, including yours, a tiny bit less valuable. Just take a look at the company Fiverr. As you can see here, the value of the new stock it's handing out to employees is often almost the same as its entire cash flow from operations. That means public investors are getting diluted at an absolutely staggering rate, and there's nothing they can do about it.
And it can get even more extreme. Palantir is a classic example. Stock-based compensation is a massive part of their business model. At times, it's been a huge chunk of their total revenue. If you're a public investor, that's like trying to swim against a really strong current.
But the ultimate, most extreme case, it has to be Snap. When Snap went public, they offered shares with, get this, 0 voting rights. Exactly 0. You give them your money, and in return, you get absolutely no say in how the company is run. It's the final form of this entire model.
So all of this sounds pretty bad for regular investors, right? So why on earth does it keep happening? Well, that brings us to our next point, why this model just won't die. It turns out there's this powerful, self-reinforcing system that keeps the whole thing going. It starts with the founders, who see control as their most important asset. Then you have the investment bankers, whose main goal is just to get the deal done, not to argue about fairness. And finally, you have big investors who, frankly, are scared of missing out on the next Google, so they buy in anyway. Over time, this cycle just repeats and reinforces itself until it becomes the new normal.
And that new normal, that global standard, has created a huge problem for one country in particular. So let's talk about Australia's capital conundrum. You see, Australia has always held the line on this. Its stock market is built on a very simple, fair principle. 1 share, 1 vote. But in a world where the biggest and best founders demand total control, that principled stance is starting to cause some very real and very expensive problems.
And those problems are showing up in the numbers. In just a single year, the amount of foreign investment flowing into Australia cratered. It fell by more than half. That's a huge drop.
To put that percentage in perspective, we're talking about a drop from over $70 billion down to under $33 billion. In the global race for capital, that is a multi-billion-dollar red flag that Australia's old-school rules might be putting it at a serious disadvantage.
So, all of this leaves Australia at a major crossroads, facing a really stark choice. Does it stay principled, or does it risk getting left behind? The choice really boils down to 2 paths. On one hand, Australia can stick to its guns, uphold 1 share, 1 vote, and protect every investor equally. The big risk there? The world's most innovative companies might just decide to list somewhere else, taking all that growth and capital with them. On the other hand, it can adapt, join the global norm, and try to attract those companies. But that would mean giving up a core principle of fairness that has defined its market for years.
And this leaves us with a final, really tough question. In a world where money moves instantly and founders demand absolute control, can a country really afford to stick to its principles? Or does taking the moral high ground eventually just lead to being left out in the cold? It's a billion-dollar question, and there is no easy answer.